While the world was staring at rockets, one of the most patient investors in history was staring at something far less exciting, a balance sheet. That is where the real story begins. SpaceX was not just another IPO. It was not another company entering Wall Street. For millions of investors, it felt like the future itself was being offered for sale. Rockets, satellites, Mars, defense contracts, space internet, Elon Musk, and the dream of owning a piece of the next great technological empire. Everything about it felt impossible to ignore. The media treated it like a historic moment. Social media treated it like a once-in-a-lifetime opportunity. Retail investors looked at it and thought one simple thing: this could be the next Tesla, and this time, I do not want to miss it. But that is exactly where the danger begins. Because in investing, the most dangerous moments rarely feel dangerous. They feel exciting. They feel obvious. They feel like everybody finally agrees on the same future. And when everybody agrees that something is too important to miss, the price usually already knows it. A great company can still become a terrible investment if the price is too high. That is the part most investors forget when emotion takes control. They look at the rocket and imagine the future. A Buffett-style investor looks at the price and asks what future has already been included in it. That difference may sound small, but over time, it separates people who build wealth from people who chase stories. SpaceX may be one of the most impressive companies of this century. That is not the issue. The issue is whether excitement should replace discipline. The issue is whether a company can become so famous, so admired, and so emotionally powerful that investors stop asking the only question that matters: what am I really paying for this business? That question is where Warren Buffett's investing philosophy becomes important. Not because Buffett hates technology, not because he refuses innovation, not because he cannot understand the future. That is the lazy explanation people use whenever patient investors refuse to chase the crowd. The deeper truth is simpler and much more uncomfortable. Buffett-style investors do not buy dreams at any price. They buy value when the price gives them protection. And while everyone was asking why he did not buy SpaceX, the bigger question was hiding in plain sight. Why was Berkshire Hathaway holding hundreds of billions of dollars in cash? That number matters because cash is not usually attractive during a market boom. When stocks are rising, cash looks weak, it looks lazy, it looks like fear, it looks like a man sitting still while the rest of the world is getting rich. But in the hands of a disciplined investor, cash is not weakness. Cash is patience. Cash is oxygen. Cash is the power to move when everybody else is forced to sell. This is what most people misunderstand. They think investing means always doing something, buying something, chasing something, reacting to something. But sometimes the most powerful move in investing is refusing to move at all. Sometimes not buying is not a lack of courage. Sometimes not buying is the only rational response when the market has turned every good story into an expensive story. SpaceX was loud. The cash pile was silent. And in markets, the silent signal is often more important than the loud headline. Because if a man known for buying great businesses is choosing to wait, then maybe the question is not whether SpaceX is a great company. Maybe the question is whether Wall Street has become so hungry for the future that it is willing to overpay for anything that sounds revolutionary. This is the hidden tension behind the entire story. Did Buffett miss the next great opportunity, or did the crowd miss the warning? To understand that, we first have to understand what the SpaceX IPO really represented. It was not just a rocket company going public. It was a test of investor psychology. It was a mirror held up to a market that has become obsessed with the future, addicted to big stories, and increasingly uncomfortable with patience. And once you understand that, the $397 billion cash pile stops looking boring. it starts looking like a message. The SpaceX IPO was never only about a company entering the stock market. It was about a feeling. It gave investors the feeling that the future had finally opened its doors and ordinary people were being invited inside. For years, SpaceX had been more than a business in the public imagination. It had become a symbol of ambition, a company that launched rockets, built satellite networks, challenged governments, supplied defense capabilities, and carried the dream of Mars on its back. To many people, buying SpaceX stock did not feel like buying shares. It felt like buying a ticket to the future. That emotional feeling is powerful, and in markets, powerful emotions can become dangerous very quickly. Because once a company becomes a story bigger than its numbers, investors stop thinking like owners and start thinking like fans. They stop asking what the business is worth today. They start asking what it could become one day. And the moment that happens, price becomes easier to ignore. The imagination begins to do the work that analysis should have done. This is why IPOs can be so dangerous. Not always because the company is bad. Sometimes the company is extraordinary. The danger is that IPOs often arrive when excitement is already at its highest point. The public is not usually invited when the business is quiet, misunderstood, and cheap. The public is invited when the story is polished, the headlines are ready, the bankers have built the narrative, and the market is prepared to pay a premium for access. That does not mean every IPO is a trap, but it does mean every IPO must be treated carefully, because the person selling knows the story better than the person buying. The insiders know the business, the risks, the timing, the valuation, and the pressure behind the scenes. The outside investor mostly sees the dream, and with SpaceX, the dream was almost irresistible. Rockets are not ordinary products. They trigger something deep in human psychology. They represent progress, power, competition, national pride, and the belief that tomorrow will be bigger than today. When a company is tied to that kind of emotion, people do not just invest with their calculators, they invest with their imagination. That is where Buffett-style thinking becomes completely different. A Buffett-style investor does not begin with the question, how exciting is this company? He begins with, how predictable is this business? He does not ask, how many people are talking about it? He asks, how much cash can this company produce for owners over time? He does not ask, can this change the world? He asks, at this price, what happens if the future is less perfect than people expect? That last question is the one most investors avoid, because when people are excited, they do not want to imagine disappointment. They do not want to imagine delays, cost overruns, competition, regulation, political pressure, accidents, valuation compression, or years where the dream is still real, but the stock price falls anyway. They want the simple version. The company is great, the future is huge, therefore buy. But markets are not that simple. History is full of great technologies that were real, important, and world-changing, while many investors still lost money because they bought at the wrong price. The internet was real in 1999. Electric vehicles were real. Artificial intelligence is real. Space technology may be real as well. But real technology does not automatically mean every stock connected to it is a good investment at every valuation. This is the key difference between believing in the future and overpaying for the future. Buffett does not need to deny SpaceX's potential to avoid the IPO. He only needs to believe that the price already demands too much perfection. If the market is pricing the company as if everything will go right, then even a good future may not be enough. The business can grow, the technology can advance, the company can remain important, and still the investor can earn disappointing returns if the entry price was too high. That is the uncomfortable truth. Most people think risk means buying a bad company. But sometimes the bigger risk is buying a great company when everyone already knows it is great. Because when everybody knows the story is usually already expensive.
This is why the SpaceX IPO became such an important psychological test. It asked investors whether they could separate admiration from discipline. It asked whether they could look at one of the most exciting companies in the world and still say, not at any price. It asked whether they were investing because the numbers made sense or because they were terrified of missing the next legendary winner. And that fear of missing out is one of the most expensive emotions in financial history. It makes people buy too late. It makes them ignore valuation. It makes them compare every new opportunity to the one they missed before. They missed Tesla, so they chase SpaceX. They missed Nvidia, so they chase the next AI name. They missed Bitcoin, so they chase the next speculative asset. Slowly, investing becomes less about judgment and more about emotional revenge against past regret. That is not how great investors think. Great investors understand that there will always be another opportunity, but there will not always be another chance to protect your capital after you have overpaid. They know the market rewards patience in ways excitement cannot understand, and they know that sometimes the strongest answer to the most exciting opportunity is not yes. Sometimes the strongest answer is not yet. And that is exactly why the $397 billion cash pile matters so much. The $397 billion cash pile is where this story becomes bigger than SpaceX, because cash is easy to misunderstand. To ordinary investors, cash often looks like hesitation. It looks like fear. It looks like someone standing outside the party while everyone else is inside making money. When markets are rising, nobody respects cash. People respect movement. They respect action. They respect the investor who is buying the hot stock, chasing the new trend, and posting big gains while prices keep climbing. But Buffett-style investing sees cash differently. Cash is not simply money that has failed to find an investment. Cash is future power. Cash is freedom. Cash is the ability to act when others lose their ability to act. In a normal market, cash may look boring, but in a broken market, cash becomes the most valuable asset in the room. That is why Berkshire's cash pile matters. It is not just a number sitting quietly on a balance sheet. It is a signal. It tells us that one of the most disciplined investment machines in modern financial history is not seeing enough opportunities at prices that make sense. And that is a very different message from what Wall Street wants people to believe. Wall Street wants activity. Wall Street wants transactions. Wall Street wants excitement because excitement creates fees, volume, attention, and headlines. A quiet investor holding cash does not feed the machine. A patient investor does not make the market feel alive. But patience is often where the greatest financial strength is built. The difficult part is that patience looks foolish before it looks brilliant. During a bull market, the patient investor is mocked. People say he is too old, too cautious, too slow, too disconnected from the future. They say the world has changed and old rules no longer apply. They say valuation does not matter the way it used to. They say the best companies deserve any price because the future is bigger than the present. But every market cycle has its own version of that sentence. In the dot-com era, they said the internet changed everything, and it did. The internet truly transformed the world. But investors still lost fortunes because they confused a real revolution with a rational price. In the low-rate era, they said cheap money made old valuation rules irrelevant. For a while, it looked true. Then interest rates changed, and suddenly the price people had paid mattered again. Today, the story may be rockets, artificial intelligence, space internet, private markets, and the next generation of trillion-dollar companies. The words are different. The emotion is familiar.
and that is why cash becomes important. A Buffett-style investor is not trying to win the loudest moment. He is trying to survive long enough to dominate the quiet moment after the noise disappears. He knows that when prices are high, returns are borrowed from the future. He knows that when people overpay today, they often spend years waiting for the business to grow into the valuation. And he knows that when everyone is fully invested, nobody has the strength to buy when fear finally arrives. Cash gives that strength. Imagine a market where everyone has already bought. Every investor is confident. Every fund is fully allocated. Every retail trader believes the future is guaranteed. Then something changes. Maybe earnings disappoint. Maybe interest rates stay higher than expected. Maybe a geopolitical shock hits confidence. Maybe one famous company falls short of impossible expectations. Suddenly, the same people who were desperate to buy become desperate to sell. That is when cash stops looking lazy. That is when cash becomes a weapon. The investor who held cash does not have to sell good assets to raise money. He does not have to panic. He does not have to beg for liquidity. He can look at the same great companies that were too expensive before and ask a new question. Is the price finally right? That is the real meaning of the $397 billion. It is not a rejection of America. It is not a rejection of technology. It is not a rejection of SpaceX or the future of space. It is a rejection of overpaying when the crowd is emotionally convinced that price no longer matters. And this is where most ordinary investors need to be careful. The lesson is not that everyone should sit entirely in cash. The lesson is that cash has a role. Patience has a role. Discipline has a role. If the greatest investors in the world can admit that not every moment is a buying moment, then ordinary investors should be even more careful about believing every exciting story. Because the market does not punish people for missing every opportunity. It punishes people for losing control when opportunity is dressed as urgency. And that may be the real warning behind Berkshire's cash pile. While everyone was focused on SpaceX launching into the market, Buffett-style capital was preparing for a different launch. The moment when fear returns, prices fall, and patience finally gets paid. To understand why this moment feels so dangerous to a Buffett-style investor, you have to go back to a time when almost everyone believed the old rules had stopped working. The late 1990s did not feel like a bubble to the people living inside it. It felt like the future had arrived early. The internet was changing everything. New companies were promising to rebuild commerce, communication, media, shopping, banking, and entertainment. Every week, another stock seemed to explode higher. Every month, another IPO made ordinary people believe they had discovered a new path to wealth. And the most dangerous part was that the main story was actually true. The internet was real. It did change the world. It did create some of the most valuable companies in history. The mistake was not believing in technology. The mistake was believing that every company attached to the technology deserved any price the market was willing to pay. That is the lesson people forget. In 1999, investors were not only buying businesses, they were buying imagination. They were buying websites with no profits. They were buying companies with no durable advantage. They were buying ideas because the ideas sounded too important to miss. And if anyone questioned the price, the crowd had a simple answer: you do not understand the new world. That sentence has destroyed more money than almost any bad business model, because every bubble convinces people that history no longer applies. Every bubble tells investors that this time is different. Every bubble begins with something real, something powerful, something that genuinely changes the future. Then the market takes that truth and stretches it until the price becomes disconnected from reality. That is what makes today so uncomfortable. Space technology is real, Artificial intelligence is real. Private space infrastructure, satellite internet, reusable rockets, defense technology, and the next generation of digital infrastructure may all become enormous industries. But the existence of a real future does not remove the need for a rational price. A great dream can still become a painful investment when the entry point already assumes perfection. This is where Buffett-style thinking becomes unpopular. When everyone is excited, the person asking about valuation sounds negative. When everyone is celebrating the future, the person asking about downside sounds outdated. When everyone is convinced that the biggest winners will keep winning forever, the person holding cash looks like he has lost courage. But history often proves the opposite. The investor who questions the crowd is not always pessimistic. Sometimes he is simply refusing to let emotion replace arithmetic. He understands that returns come from the relationship between what a business becomes and what you paid to own it. If you pay a perfect price for an imperfect future, even a strong company can disappoint you. That is why the comparison to past bubbles matters. Not because today is exactly like 1999. No two market cycles are identical. The companies are different, the technologies are different, the economy is different. But human behavior is not as different as people believe. Fear of missing out still exists. Greed still exists. Overconfidence still exists. The belief that this company is too important to fail as an investment still exists. And when enough investors believe that at the same time, the market can become dangerous even while the underlying technology remains extraordinary. This is the uncomfortable truth behind every great market mania. People can be right about the future and wrong about the stock. They were right that the internet would matter, but many were wrong about which companies would survive, how long profits would take, and what price made sense. They were right that innovation would reshape the economy, but they were wrong to believe that excitement could protect them from valuation. That same danger exists whenever investors chase a story because it feels emotionally impossible to ignore. And this is why Buffett's cash pile becomes more than a personal decision. It becomes a warning about market psychology. If a disciplined investor sees the future but refuses to overpay for it, maybe he is not rejecting innovation. Maybe he is remembering what the crowd always forgets at the top. The rocket may be real. The dream may be real. The company may even become historic. But none of that answers the only question that matters to an investor. What price are you paying today for a future that has not happened yet? Until that question is answered with discipline, excitement is not an investment strategy. It is a risk wearing the costume of opportunity. So what is Buffett-style capital really waiting for? Not a rocket launch, not a headline, not the next exciting IPO. It is waiting for something much older, much quieter, and much more powerful than hype. It is waiting for price to come back to reality. That is the part most investors find difficult to accept. They believe opportunity is always something loud, a new company, a new technology, a new billionaire founder, a new market trend, a new stock that everyone is talking about. But in the world of disciplined investing, the best opportunities often arrive when nobody wants to look at them. They arrive when fear has replaced excitement. They arrive when great businesses are no longer being priced like perfect dreams. This is why cash matters. Cash gives an investor the ability to wait without being forced to act. It gives him the power to watch the market become emotional without becoming emotional himself. When prices are too high, he can say no. When panic finally comes, he can say yes. That sounds simple, but it is one of the hardest things in investing because human beings are not naturally patient when everyone around them appears to be getting rich. During the boom, patience feels like punishment. You watch other people chase the hottest names. You watch stocks climb higher. You watch headlines celebrate investors who took bigger risks. And slowly, A dangerous thought enters your mind. Maybe discipline is costing me money. That thought is where mistakes begin. Because the market does not only test intelligence, it tests emotional control. It tests whether you can watch others make money without abandoning your own rules. It tests whether you can separate a great company from a great price. It tests whether you can admit that some opportunities are real, but still not right for you at the current valuation. That is the lesson ordinary investors should take from this story. You do not need hundreds of billions in cash to learn from Buffett's patience. You do not need to copy Berkshire's portfolio. You do not need to predict the exact top of the market or the exact bottom after a crash. The real lesson is much simpler. Never let excitement make you forget price. SpaceX may become one of the most important companies of the next century. It may change space travel, defense, satellite internet, and the way nations think about technology. But even if all of that is true, an investor still has to ask how much of that future is already priced in today. If the answer is almost everything, then the risk is no longer just business failure. The risk is disappointment against perfection. That is what most people miss. A stock does not need bad news to fall. Sometimes it only needs good news that is not good enough. Sometimes a company can grow, execute, lead its industry, and still produce weak returns for investors who bought at a price that assumed a flawless future. This is why Buffett-style investors respect the power of waiting. They know the market always gives another chance. Not every day, not every month, sometimes not for years, but eventually emotion swings the other way. The same investors who once said a company was impossible to miss suddenly decide it is impossible to hold. The same market that demanded any price for the future suddenly refuses to pay a fair price for reality. That is when patience becomes action. And maybe that is what the $397 billion is really saying. It is not saying America is finished. It is not saying innovation is fake. It is not saying SpaceX is a bad company. It is saying that even the greatest future must be bought with discipline. It is saying that capital should not be forced into overpriced dreams just because the crowd is impatient. It is saying that the investor who keeps dry powder today may become the buyer everyone needs tomorrow. So the real question is not whether Buffett missed SpaceX. The real question is whether ordinary investors are missing the warning hidden behind his silence. Because the rocket was loud, the IPO was loud, the media was loud, the crowd was loud. But the most important signal may have been the quietest one of all. Hundreds of billions of dollars waiting, not because the future is unattractive, but because the price of that future may still be too high. And in investing, the future only rewards you when you survive long enough, wait patiently enough,